I'll start with my big takeaway for today, and that is to keep good records. This is something that you should be doing anyway, even if there was no tax time. Keeping good records on your finances lets you know how your Airbnb portfolio is performing.
You found the Real Estate Law Podcast, because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. If you're a real estate professional or looking to build real estate expertise, then welcome to the conversation and discover more at realestatelawpodcast.com.
Welcome to the Real Estate Law Podcast. My name is Jason Muth, and we're here once again with real estate attorney, real estate broker, Rory Gill from Next Home Titletown Real Estate and Urban Village Legal here in Boston.
Yeah, Jason, how are you?
I'm doing great. These intros are just tough, huh? Like, especially on video, like you could see the awkward pauses.
Yeah, but I'm happy. It's tax time. It's that wonderful time of year that we get to send off our 1099s, complete our 1120Ss, and then our 1040s. It's a wonderful time of the year.
So 1099 plus 1140S plus W-2. If you add it all up, what's that, about 3,000? I don't know what I'm doing the math on, but yeah, taxes is high on the list of things that we should be talking about this time of year. We're all receiving our tax forms. When you're listening to this or watching it, maybe it's before tax time, or maybe it's after tax time, but you know, these tips should still be helpful to you. We're talking specifically about short-term rentals, Airbnb properties. Airbnb has kind of become the verb, hasn't it?
Yeah, in drafting what I was going to say, I keep trying to force myself to say short-term rentals because that's the more correct, more encompassing term. But yes, I just reduced down to Airbnb-ing a house.
Right. It's like Googling something on Bing, right?
Yeah, absolutely. Just like that. Yeah, we Airbnb'd it on Verbo. Sorry, this podcast not sponsored by Verbo today. But we do we do love Verbo. I mean, we as it's very well known that, we have short-term rentals ourselves and we get tons of bookings on Verbo and on Airbnb. So, equal love for both so next week's podcast will be sponsored by Verbo.
By Verbo. Okay, yeah. So, but the tax tips are going to be the same because it's short-term rentals. Although I will say taxes are handled differently by those two platforms. It's a whole separate conversation,
Sure, and that's a different tax. And I guess if we want to be precise, we're going to talk today about income tax tips for Airbnb owners, because we could have another whole thing about property taxes and about boarding taxes and state taxes that go along with running a short-term rental. Because why hit you with one form of tax when they can get you with a whole series? But this time of year, this is income tax time, and for Airbnb owners and real estate investors, it's a pretty complicated time of the year. Not necessarily a bad thing. There are a lot of great ways to find tax advantages and deductions out there, but it is complicated. It takes a little bit of brain power to distill everything down onto that 1040 where it all ends. And I know we're working on it for ourselves right now just to make sure that our records are lined up for last year. But I'll start with my big takeaway for today, and that is to keep good records. This is something that you should be doing anyway, even if there was no tax time. Keeping good records on your finances lets you know how your Airbnb portfolio is performing. So if you don't keep these records, if you keep these records only for taxes, you're missing out. These are also going to be your performance metrics to show how well your investment is performing.
So I keep all the records for the short-term rentals that we have. I think they're pretty good. I mean, you've seen them, right? The end of the year, it's I keep it in simple spreadsheet. So at the end of the year, it's just a pivot table, and it kind of shows how much we spent on each category, and whether or not it is something that we could depreciate or write off or what have you.
Yeah, so there's a separate conversation about how exactly to keep the records on what platform, but just keeping them and updating them regularly, not waiting until the very end of the year to go back and remember what you bought at Home Depot in February. So keeping track and keeping things updated is going to make tax time much easier and make it less likely that you're going to forget about a deduction that's out there for you.
I'm pretty militant about anything that we spend money on for the short-term rentals. You mentioned just that quick little receipt from Home Depot. Yeah, everything. I mean, I just keep track. I mean, if it's supplies, because with short-term rentals, you're dealing with toilet paper and paper towels and linens and, fixing doorknobs and filling up the propane tank and just a long list of things that maybe a typical long-term renter doesn't have to worry about. Cable, internet, all those things. I mean, and every so often I'll forget something. And that's why I still like paper bills. I mean, because I like the paper sent to me. I don't like it when people charge me $2 a month for paper bills. I'm not going to name names, but they're out there. And when that happens, I'm cheap enough to then, get electronic bills for them. But, I love being able to see the records of where we're spending the money so I can keep track of it. And, at the end of the year, when it comes time to pay our taxes, we pay the fair amount, so we're writing off things that, qualify, and we are depreciating things that, are a little bit longer term of something that, we could take depreciation on, and things that you can't write off, you don't write off. I mean, but, I think one of the benefits of having these short-term rentals is that the properties appreciate in value, and you're able to depreciate things, and take that depreciation each year, right?
Yep. So I don't want to get too ahead of ourselves, but just with the moral of the story of keeping good records for these short-term rentals, also you want to be able to separate your business and personal purchases. That trip to Home Depot, how many things in the cart are attributable to the rental property? How many of them are personal purchases? What in that cart is a repair, and what in that cart are supplies? These are different things that you may have to separate for your taxes. So keeping everything updated regularly is going to make it so much better. I mean, I don't remember what I did last week most of the time. I don't know what I purchased at Lowe's in March. So it's Keep good records, keep them updated regularly. It's going to make tax time so much better. You're going to be more accurate. You'll catch your deductions, and you're less likely to get into tax trouble.
Let's take it one step back also and start kind of on the revenue side, because, we mentioned Airbnb and Vrbo. There's plenty of other platforms also on which you could rent short-term rentals. And those, if those platforms are going to handle money, if the guests are going to remit money to them and then they're going to send money to the landlord, they're going to send a form at the end of the year, a tax form, sometime at the end of January. What is that? A 1099?
Yeah. So they'll be sending you a 1099K. This is this income's reported to the IRS, but it's a nice, easy form. They've kept track of it for you. You still want to take a look at it to make sure it's accurate and it lines up with your records. But every one of the platforms that transmit automatic payments to you after the bookings, they're going to send a 1099K to you.
Right.
Same thing if you had a cupcake store and the credit card companies were processing your sales for you. You'd get a 1099K.
Yeah. This year, I even got one from PayPal. And that was a weird one because I had this one guest who, for some reason, they couldn't make a payment on Vrbo, and I reached out to the platform, and they suggested just taking the money separately. So we decided to use PayPal for that because it was a secure method to transfer the money, and PayPal took a fee. Which stunk, but it did. And then at the end of the year, they sent me a record that they transmitted the money to me. So I have to make sure we account for that.
And when tallying up your revenue, get your 1099Ks in order. Make sure that you've received them from each of the input sources. And if for those transactions without an intermediary, make sure you kept good records of those too, because that's income that you'll have to report outside of the 1099Ks.
Yeah. Now, the 1099K in some states, because we have one in Mass and one in New Hampshire, and the tax laws to the states are both different. Whereas in Mass, I forget which one it is. In New Hampshire, we're remitting our own sales tax to the state, right? And then that's not shown on the forms that are sent to us. But in Massachusetts, Airbnb sends all of the tax money that they collect. So that would not be money on my 1099K, right? If it's money that Airbnb is going to charge the guest, tax, send it to the state, that's not considered revenue for me.
No, so if it's noted on the 1099K as such, but yes, regardless of how it's reported on the 1099K, the the room tax that you pay to New Hampshire and the room tax that you pay to Massachusetts, they're deductible off the top line of your income.
So if we're paying it, if the host is paying the taxes themselves, then that's going to be deductible, right?
Absolutely. So state and local taxes are a legitimate business expense, and that is an expense directly tied to the operation of the Airbnb.
Right. Okay. So revenue, we got the revenue side of it. Just keep good records as to who booked your place. Take all the 1099-Ks that are sent to you. Write down any direct payments that you're taking. You'll have how much revenue you brought in. Now, we kind of got into the deductions already. We started talking about any sales tax that you have to send over to the state. What are some other things that you could be deducting off of your income taxes from your short-term rentals each year?
So basically anything and everything that goes into the property itself. So keep the records of all the supplies, all of the utilities, all of the cable, everything that goes there, and make sure that they're categorized well. Some of the larger purchases and the larger repairs are going to be depreciable assets. So you'll need to keep those separate and schedule them out. I don't want to date this particular podcast because each year there are different things eligible for bonus depreciation, and that's a big, long political choice that the government makes every year. But so you may be able to instantly depreciate certain things that you put into the property, but make sure that everything's well categorized in your system so that you can attribute it correctly. Other things that you want to deduct that are not as readily apparent as the immediate supplies and utilities are, for example, your mileage. We know that if you're an independent contractor driving around for work, you can deduct your mileage. Well, the same is true for Airbnbs. Yes, for most people, this is going to be kind of on the margins and a relatively minor deduction, but it's something that if you keep good records and you track your mileage for your Airbnb purposes, it's all deductible. So driving up to check on the property, driving around to pick up supplies from local stores, and returning from the rental property, those may very well be deductible mileage for.
Right. What if this is a room in your primary residence? We don't do that, but I know that's kind of how Airbnb was founded. It was renting out extra rooms that you have, or if you have a accessory dwelling, is that what's called? If you have a second property or second
ADU,
building,
yes, yep.
Yeah, on your property. So what about that? You live there full time. You got this one bedroom. You get 80 renters a night from it, or 80 renters a year from it.
So this is in the broader category of prorations, just because a lot of Airbnb properties have multiple purposes. So you're renting out portion of what you own, either in time or in space, to somebody else. So you do need to keep track of the prorations for if you're renting out a room in a property that you otherwise occupy the rest. Just like a home office, you're going to take a look at the square footage that's dedicated to the room. Now, all of your operating expenses will be deductible 100%. So if you're buying supplies that are specifically for the rental, the cost of the platforms, the cost of the marketing, all that's 100% deductible for that operation. But then your household expenses, such as the heat and electricity, that's going to be prorated down to generally the square footage of the space that you're renting out. And it also bifurcates the amount of your property tax that you're deducting for personal reasons and the amount that you're deducting for business reasons. But, and that leads into kind of probably the more common situation where you have an Airbnb that you also use as a second home. If you have the lake house or the beach house where you also spend a few weeks a year and then you rented out the rest. Well, that portion that you're using yourself isn't deductible. That's not a business expense. So one other thing that you need to keep track of throughout the year are the days that are being used, occupied by somebody else who's a paid guest, the number of nights that you're occupying it for personal use, and then interestingly, the number of nights that you're occupying it personally, but for maintenance reasons. So if you're visiting a property to go in and check on the property to make repairs. These have to be really. I mean, if you're up there for 2 weeks, you're not up there for 2 weeks just for maintenance reasons, unless you really are. But if you're there and you go up there to fix a plumbing issue, you can still go to the beach that day, and it's an appropriate maintenance day. But how that works in practice is they divide the use at the end. So they take the number of, you find the ratio of the number of nights that it was used for rental purposes and the number of nights that you use it for personal purposes. And those maintenance nights are excluded from the equation. So they don't count against your personal threshold. And then you take that percentage, say 85% of the usage was for rentals, and you prorate all the housing costs that are, just general to the whole property, and you deduct 85% of it. So the electricity, 85% of the electricity would be deductible, and the other 15%, it's not deductible because you consumed it personally. But in the end, that makes sense. But keep in mind those expenses that are truly for the rental, the photography, the advertising, the platform fees, those are still 100% deductible because all of that is attributable to the business.
Right. Okay. What about some other things that you might not consider? Like, we love Bigger Pockets. I have a membership on Bigger Pockets. I do networking on there. I network with other short-term rental owners. And I think, I forget my tier. I think it's like $99 a year. But I've included that on deduction worksheets. I don't know if it's been deducted, but I've included it, because I figure networking and education is important.
This episode sponsored by the IRS. So what I would keep in mind that your Airbnb is a business like any other. So all the other kind of expenses that you would use for business, they apply in this situation too. So think about, we talked about mileage as kind of one of those expenses that might be forgotten by a number of Airbnb owners. But think about loan interest. Of course, you're going to be writing off the mortgage interest. That one people don't necessarily forget. But what about credit card interest? If you had to purchase furniture or something and you put it on a credit card or other type of loan, that interest is deductible. It'll be easier to track if you have a separate credit card that you use for the Airbnb business purposes. But that interest, nevertheless, is deductible because it's a business expense. You're paying interest on debt you incurred to run the business. And think about, just like other businesses, if you travel for a bona fide reason to go to an educational seminar or learn more or network for the purposes of growing your Airbnb network, that's deductible too. If you have a property, if you live in Boston, have a property in Maine, but you fly to Las Vegas to go to an Airbnb conference, well, that trip is also going to be deductible, just like any other business trip that you take for your cupcake business, which is always my standard comparison.
Your cupcake business. Is this something I don't know?
It doesn't make much money.
I mean, you bake more than I do. I don't bake that much. I do cook a lot though. So I guess it's plausible you have a cupcake business somewhere on the side.
Do not. Nobody would pay for that.
Let me just do like lightning round things that maybe, you could kind of deduct off your taxes if you're an Airbnb owner, things that folks might not have known about, because we talk about this a lot with folks in the real estate biz who also do short-term rentals. We have some friends that also have some short-term rentals that are dipping their toe and starting to think about doing this. And one thing I want to talk about with that, about putting our place in service during a certain year, which we'll get to in a second. But let's say that I had stationery made for one of the properties, with a logo on it. Like, can I deduct that?
So before I answer any of these, there's a disclaimer: talk to your tax person. We're not giving you. So keep in mind as I answer these questions, just a general disclaimer: we're not giving anybody actual tax advice. You want to talk to your accountant. You want to talk to your tax professionals before you go ahead and do anything. But what you just outlined there is a legitimate marketing expense that you can use on your taxes for your Airbnb business, just the same.
Okay, perfect. So stationery is fine. What about if I have coffee and creamers and sweetener for my property? Can I deduct that?
If it's a supply that you're giving to your guests as part of the stay, yes, It's a supply.
What happens if I am upgrading the furniture? So I have a bed and a dresser that I bought new for the property.
That may be a capital expenditure that you want to possibly depreciate over time. Reference that year's tax standards and that year's depreciation standards, but that is a deductible expense, but it may need to be depreciated over time.
Okay. Painting the house.
Same. That is an improvement that may need to be depreciated over time.
Replace the toilets.
Same.
Fees that you pay to Verbo for the subscription.
Deductible that year as a marketing operating expense.
Gas that I put into the car on the way up to one of the properties.
Depends how you treat your car for taxes. If you're doing actual expenses or mileage, you can pick one method or the other.
What if you supply Netflix for your guests?
That's a utility.
That's a utility? Netflix is?
Perhaps the categorization might differ based on which accountant you're using, but that's a deductible expense if it's purchased as a provision for your guest.
Right. Saying, okay, we have, you could stream content here at the house, enjoy. And what if you're planting bulbs outside?
That may be a depreciable expense over time.
Tulip bulbs are depreciable? They're like $1 each.
Check with that year's particular rules. No, I'm gonna hesitate to give like that precise of tax advice because some of it does matter if it's purchased kind of to replace last year's bulbs or if it's part of a landscaping project.
Right.
There is a subtle difference that has to be done. You can't just do a great big landscaping project and call it supplies for that year. That was an actual undertaking that you made.
We should have another episode where all I do is rapid fire throw things at you saying, is it depreciable? Can I write it off? Or, am I SOL?
Well, we may need to be joined by an accountant for that episode just so we can compare notes. And then we'll answer every single one of these as it depends.
Fair enough.
Just to be precise.
Before we wrap up, let me mention one thing about putting your place in service. You mentioned this to me after we got the very first place where, I think we purchased September. And we started taking rentals. I think it was that December, or at least we put it in service in December. What exactly does that mean?
So that's a key component. So when you can start to deduct expenses on your taxes, including starting the clock on depreciating assets, it really depends on when you place that asset in service. And placing something in service doesn't mean that you have somebody in, but when you first make the place available to rent, that's the tax year when you can first start to deduct against your income for the Airbnb. So if you are heading into December and you are anxious to get the contributions you made that year onto your taxes, you may want to consider placing it in service, getting that listing up before the end of the calendar year, and actually placing it in service to start the clock. Conversely, if you do the math, you may want to hold off and wait until the new calendar year if you really want to kind of keep those deductions against in a year where you're expected to have more income. So
right.
Understand the concept. I don't want to give you advice as to when exactly you should place it into service, but you can start the deductions the year that you first make the space available. For most people, that'll mean when you first put the listing up.
One last situation, let's say that you put it into service in February and you purchased the previous year. All the work that you did on the place leading up to that, you keep track of it, keep the receipts, keep it on a spreadsheet. Can you carry that over into the next tax year?
So that'll be your initial basis. So everything that you've taken up until that time and first put it into service, that will be your initial basis in the property. So you may not be able to separate particular projects and depreciate them separately, but yes, those things those expenses that you took in the prior year, they're not lost.
Got it. And through all of this, make sure that you consult with a tax attorney or a tax preparer or a CPA who could probably give you a lot more specific information about this because this is technically an entertainment podcast, isn't it?
Yeah, but when it comes down to taxes, be proactive instead of reactive. So talk to that tax professional the year before so that you can shape your decisions in your business to give you the maximum benefits. Otherwise, all you're doing is just taking a look at what actually happened and processing the numbers. So you can be reactive for last year, but be proactive for this year and all future years.
Sound advice. Thank you once again to Rory Gill, real estate attorney, real estate broker for Urban Village Legal, Next Home Title Town, real estate in Boston. Thanks for joining us today. Where else can we find you? So it's nexthometitletowrealestate.com.
Next
What if they
Home
want
at
to email you?
nexthometitletownrealestate.com, Rory at nexthometitletown.com, or they can reach me at urbanvillagelegal.com as well for your legal advice.
Excellent. Or you're on LinkedIn. I'm on LinkedIn. We're easy to find. We'll put it in the show notes.
I'm pretty easy to find.
Yeah.
Just look for Rory Gill Boston. You'll find me.
All right. Well, thank you, Rory Gill Boston. Thanks for everyone for listening. This is once again the Real Estate Law Podcast, and we'll look forward to talking to you again. Bye.
This has been the Real Estate Law Podcast. Because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. We're powered by Next Home Titletown, Greater Boston's progressive real estate brokerage. More at nexthometitletown.com. And Urban Village Legal, Massachusetts Real Estate Council, serving savvy property owners, lenders, and investors. More at urbanvillagelegal.com. Today's conversation was not legal advice, but we hope you found it entertaining and informative. Discover more at realestatelawpodcast.com. Thank you for listening.